Good morning, and welcome to the panel on the future of benchmarking. I'm Yakob Peterseil. I'm an editor at Bloomberg News. It's hard to think of a time when indexing, there's been as much talk about it as there is today. Depending on which side of the fence you're on, the rise of indexing is either the greatest thing to ever happen to asset management or the worst. On the one hand, it's increased market access for millions of investors. It's saved them probably billions of dollars in fees, but it's also given indexing companies unprecedented power and may even be leading to crowding in certain parts of the market. Wherever you stand, it's not a debate that's going away anytime soon, which is why we are here this morning to talk about it. So please join me in welcoming our panelists. To my right, Isabelle Bourcier of BNP Paribas Asset Management. Isabelle is head of Quantitative and Index Management at the firm. Welcome, Isabelle. In the center, we've got Fong Chan. Fong is Senior Product Manager for Sustainable Investment at FTSE Russell, where she manages the firm's index products in this area. And finally, Sanjay Rao of Bloomberg Barclays Indices. Sanjay is a product manager and focused on research and development of fixed income benchmarks. So welcome all. Isabelle, I wanted to start with you. We hear a lot of talk today about indexes, that the lines between active and passive are being blurred, if not completely demolished in this area. Can we even refer to indexes today as passive instruments, or are they more and more reflecting active decision making?
So to answer to your question, there's two folds. One is regulation. I mean, there's very strict guidelines under the BMR and under UCITS guidelines when it comes to ETF, when it comes to index fund. An index has to be transparent, full disclosure on the methodology, completely rule-based, so that an investor has the capability to recalculate the index. Can you call it active? I'm also managing active management on the quant side. I can see how the managers are working. When it comes to active, it means discretionary decision. It means an ongoing process in research and changing models in order to adapt to new rules, to new developments in order to increase the robustness of your process. So indexing remains passive in the sense of the regulator and in the sense of the way it's managed. Our portfolio manager on the index side, their target is to replicate as closely as possible the performance of an index. They cannot take active decision. So for me, an index remains passive. I can see, it coming from the index industry and also from our industry on the ETF side. Everybody's looking for innovation, but it has to remain predictable for the investor because we are selling an investment tool, a vehicle that should enable the investor to enter and exit at any given time throughout the day. So scalability, liquidity is key factors when it comes to manufacturing ETF. And I think that's, we should not be too marketing around the concept of a number of indices, call it active just for pleasing ourselves in the sense of intellectual property or in the sense of the intellectual work we put into designing those indices. In terms of replication from a fund management perspective, this is passive and not active.
Do you think there's pressure from clients on providers to perhaps add something extra to an index rather than just a passive benchmark? Well, this index is special because of this or this.
There's more and more pressure for investors to, transparency is key. We ask a lot of analysis in terms of performance attribution on every type of indices that we replicate and on the ETF itself. So there's a lot of demand also in terms of predictability. I think also, and it was discussed in the next panel, because there's a lot of developments on the fixed income side, on ESG, there's a lot of demand for customization. And that's where we need the help of the index industry in order to bring those capabilities to our investors.
Now, on the topic of customization, Fong, you're a specialist in ESG and sustainable. That's an area where everyone seems to have their own idea of what is ESG and what is sustainable. How do you navigate the sort of active-passive tension there with those benchmarks?
I think I want to be a bit careful about how we use the term active. I think in this context, if we're referring to is there a rise in the number of indexes where we're taking into account specific investor considerations? Yes, there's definitely an increased uptake and work being done in that area. And as many of you know, ESG is become a core theme for many investors due to drivers like regulation, investor initiatives, public demand. And it's no longer just a theme, a thematic area, a peripheral area. We're seeing investors wanting to integrate this across their portfolio. And the paths to implementation, well, that differs, depending on what the investor's sustainability objectives are, what their investment objectives are. And when it comes to sustainability objectives, are they wanting to integrate broad ESG? Are they wanting to focus on specific themes like climate change, diversity, inclusion? On the investment financial metric side, a lot of them are also thinking about what kind of risks do they want to take? Do they want to minimize tracking error, tracking very closely to the market cap, or do they have higher conviction? Are they willing to deviate more from the market cap? And so all these things are things that we need to, as an index provider, as we're designing these indexes, think about. But the good news is, as this industry has developed, providers like ourselves, we're starting to build capabilities to be able to accommodate for different objectives. And what's starting to happen, and as many of you are probably aware, is that there's a spectrum of ESG indexes. But what this allows us to do is then be able to have building blocks for portfolio construction, indexes that may cater to different investment horizons, different risk appetites, and as well as different levels of sustainability convictions.
Going off what you said, are we ever going to have a future where ESG or sustainability becomes more standardized, or are we always going to have this sort of fragmented, customized landscape? How do you see it playing out?
I mean, my personal view is that I think there will continue to be different views on objectives. And partly because sustainability issues are evolving. I mean, if you look at, in the past, let's take climate change, for example. There has been a large focus around low carbon, reducing use of fossil fuel. But now the attention is turning towards the green economy. Now, how can we increase our investments and adoption of alternative energy, green technology? And last year we did a research on the green economy, and we found that actually the green economy is significant. Of global listed equity markets, around 6%, $4 trillion are derived from the green economy, and this is growing. And if you compare this to the fossil fuel super sector, this is an area that's shrinking. So this poses a significant opportunity for investors. But the point being that sustainability issues, they're evolving. People's understanding of these issues are evolving, as is the research and the priorities are evolving. And so is there going to be one standard? In my view, no. There's not going to be one golden standard. There is no one-size-fits-all solution because of different preferences, because of how these issues are evolving.
There's one thing I want to add, because while meeting clients and country per country, there's not the same standard when it comes to talking about ESG. In France, everything is about SRI. You get out of France, SRI, the best-in-class approach is, why? I mean, in certain areas, exclusions only is preferable. In others, they want ESG integration. Climate is becoming something very important everywhere in terms of decarbonation of the portfolio. It's not just purely from a regulation perspective. And at the moment, at the AU level, linked to the EU taxonomy discussion, there's a lot of discussion around defining what is ESG and what ESG indices should be, what it should give in terms of transparency on the methodology. Because clearly, it's an area which is growing very fast and on which clients want more and more information, but where the definitions are very different from one country and even from one client to another. But for sure, when you talk with private banks, the thing they tell you is that clients want to make sense in terms of investment. So picking up a fund or an ETF, they want to know what is behind and what is the consequences on the climate, on the environment, of their investments. So it's really changing the way the market and the distributors are considering even ETF and indexes.
Actually, I'd like to add to that. From the fixed income experience, we've had a fixed income partnership with MSCI to create our ESG family. And 5 years ago, we launched it, And I was having conversations with portfolio managers, and they weren't even aware that their ESG office had a strong presence in the ESG market, effectively. There was no connection between the two, and you would introduce them to the teams. Now that's absolutely not the case. Everyone is looking to have an integrated approach across the board. But to reflect to your points, though, there's a cultural difference. If you talk to US managers, they're all looking for optimized baskets. They think ESG is a source of outperformance. It shows you your credit skill. It shows your ability to beat the market. And so they want to try and wrap that in a way that gives you an outperformance. Whereas in Europe, it's more of a structural understanding that there is a long-term value to being a responsible investor. So they've looked to try and push that through as a way of defining themselves. But what we've seen in Europe, what you see like in questions of the specifics. So if you talk to German investors, nuclear power is the problem. You talk to French, it's the solution. So it's that sort of disparity that you have. But we have seen on the ETF side a sort of coalescence of products. So initially there were a range of different ESG products which had different types of exclusions, either SRI or ESG scores. And now there seems to be a moving towards a joint SRI and ESG partnership, or including both themes into your benchmark. But one of the things we're actually seeing across the board in Europe on fixed income is the low carbon fossil fuel reduction. It looks like while there is a disparity in each region or each country, there is a general broad usage that people are moving towards, which covers both ESG, SRI, and fossil fuel or low carbon reduction.
I think I want to go back to your point around transparency, because one question that we often get as a provider of ESG research and as well as indexes is about differences in opinions and methodologies. And I think, having heard the panelists here, clearly there are different preferences due to regulation, due to local culture, and also preferences in terms of issues. And I think this is reflected as well in how providers have different ways of interpreting and assessing companies and assets. So, one thing that I think is really key as an index provider is providing that transparency and also clarity on how is the index constructed, and as well as how is the data set itself constructed. And what I think is important for us is communicating what exactly is that index trying to achieve, and as well as what is the data, that assessment trying to achieve, and then allowing investors to lift that hood and then see what's going on. In some cases, for example, we have our overall ESG ratings, and some investors agree with that approach, they agree with that outcome, and so they want to take that overall ESG rating. But then there needs to be the ability to lift that hood, unpack it, take apart, and perhaps choose more granular levels of data, and then choose what they want to focus on and how strongly they want to focus on it. So that transparency, and as well as that rules-based logic and rationale needs to be intact in there.
Yeah, no doubt we could spend the rest of the panel devoted to ESG. I did want to go to the polling question we have for this panel, and I'll ask it of my panel, of course, as well. So if those in the audience could please take out their phones, and we want to hear from all of you. If you go to our event app on your phones to the polling section, futureofetfs.app, and the question we have for you is this: which asset class has the most room for index innovation? Is it equity, fixed income, commodities, or alts? That question again, which asset class has the most room for index innovation? Equity, fixed income, commodities, and alts. And as we watch the results come in, how I pose that to my panel. What do you think?
From my perspective,
you have a bias.
Yes. Well, no, I've been on many panels over many years, and frankly, with the dull cardigan-wearing older brother of the equity indices, we take longer to produce things. We're more fixed in our ways. I think equity, with the greater liquidity, the greater transparency in terms of corporate actions and terms and conditions, it's easier for them to effectively throw everything at the wall, see what sticks. If it works, then they'll carry on doing it. If it doesn't work, they get away, they drop it. Whereas for fixed income, it's a completely different structural market. I think if you think of, like, JP Morgan have one listed equity, they have 70,000 bonds. If you look at pricing, so ESMA defined what liquid equity securities were. There are 1,500 liquid equity securities defined by ESMA. There are 476 out of 70,000 bonds that are defined as liquid. The whole process of managing a fixed income portfolio is a lot more difficult, and that's why I think we've got a lot to do in terms of developing new products.
Okay, we know where you stand, and the audience seems to agree with you with 61% fixed income, so consensus there. Pivoting a little bit, Isabelle, I know you come from a quant background, and in terms of innovation in indexes, multi-factor is quite hot right now, this sort of cycling between various factors in equity and fixed income. Can you give us an idea of what the state of the art is today in multi-factor indexes and what you see as the potential there?
So we actually, on the quant side, we run multi-factor and single-factor funds, but not index-based, especially on the multi-factor credit, because you talk about fixed income initially. So there's an issue with fixed income, and why there's a room for a lot of increase in terms of innovation is that it's an OTC market. So it's not always adapted to do pure indexing, especially on multi-factor credit, because you need to have some flexibility to find the depth in the market to properly provide for a quant multi-factor strategy. So I don't believe this can be done efficiently in an index format, typically. But yes, we've seen a lot of interest in terms of multi-factor in indexes and single factor initially. I mean, there's two views from clients. Some think they can time factor and they will look for single factor ETF as a format to be able to enter and exit easily. On the multi-factor side, to be honest with you, still believe that a fund might be more adapted, but it's linked also to the way funds are being distributed today. Why would you want to enter and exit intraday a multi-factor strategy on the equity side, on the fixed income side? I think a lot of clients are also going to ETF for cost reason, and also because the due diligence process is quicker to do than a traditional fund. So it's the ease of accessing the multi-factor strategy, which is important. But if you go back to, in essence, why you're looking at ETF and indexing is for intraday liquidity, and I don't see the point here. I think multi-factor as in a fund format works as well or even better than in an ETF format.
And do you believe investors can time factors properly, or is that something better left to an automated system?
From the research coming from BNP Paribas Asset Management, we don't believe in timing of the factors.
If I may add a bit of an ESG perspective here. So we run a smart beta survey each year, and we survey asset owners on their perspective on smart beta strategies. And we've brought in an ESG angle into that survey, and what we found is that in our survey, over 40% in 2017 of the asset owners that were already using smart beta strategies or were considering using smart beta strategies, they were interested in bringing into their factor indexes, also ESG considerations. And more recently, in the last couple of years, we've seen, particularly in Europe, more interest from asset owners wanting to bring these two areas together. And I think part of it is that move away, that comfort level in moving away from market cap indices. But it's also a reflection around how investors are starting to think about how ESG can present a long-term risk to them and wanting to integrate this alongside their factor considerations.
I mean, to give you an example, we have integrated in our multi-factor strategies credit and equity ESG with 50% decarbonation and 20% enhancement in terms of ESG scoring in December. If we had been based on an index, we would have had to wait for an index to be built and then change the index, so that it would have been much more complicated for us to do it rather than managing it actively.
And fixed income is obviously an area. Whenever we do a story about factors in fixed income, we get tons of response and reader interest. Sanjay, what's going on there in terms of development there?
Well, so I think, we've had this conversation for about 10 years in terms of people have seen the success on the equity side and they've wanted to translate that into the fixed income side. There's always been the issue of replication. How do you find the liquidity for the bonds? How do you deal with the transaction costs? How do you find the depth in the market to be able to replicate the actual strategy? We've done a lot of research, and we've published a piece recently about factor models where we've look to try and produce style, the like low, so carry, momentum, vol, and a multi-version of this. And the reaction has been very positive. We've accounted for transaction costs, and we've made sure that we can actually have a rebalanceable portfolio. So I think what we're expecting is over the next 6 to 12 months to be able to offer this to clients and see what the reaction is. But similarly to ESG, it's a conversation that's going to take 5 years probably to develop because of the difficulty in actually replication.
One of the criticisms of the indexing business as it gets bigger and bigger is that its index providers are exerting more and more influence over markets. Is that a reality in your guys' view, or is that something we need to worry about, or is that overblown?
So, speaking as the index provider, I'm going to say no. But the basic thing is, we've used index a lot and it's synonymous with passive, and I don't think that's actually true. What the reality is, the index is supposed to reflect the consensus opinion of the investable universe for a particular market. It's the asset class beta. And that's supposed to be the level playing fields that you can judge the active manager and also look at the passive manager's ability to replicate the beta. And it is difficult to replicate the beta. We are effectively a gross product where the asset manager has to take care of transactions to match that return. And it's important to recognize that. So the index is supposed to be neutral, and it's supposed to define a consensus. For what we do, in terms of making sure that we have that is a strong governance process where for 20 years what we've done is had panels in New York, London, Hong Kong and Singapore or Tokyo, and looked to try and have a discussion about what is important and what are the changes of the markets, because markets do develop. It's not a static process, product. So if you look at the inclusion of China that we announced last year for inclusion in April, that involved a 3-year process where the issuer kept changing the structure of their market. They had programs like QFII, RQFII, Bond Connect, all trying to open up their market. And we had to talk to clients in each region who have different investment goals and different investment styles to try and understand, was it accessible and was it the right opportunity set for them? And what we found was over the 3 years that we got to the point where we thought the majority of people thought it was the right investment or the right opportunity set. And so to a certain extent, that means that we were reflecting the majority view, but for a small portion, we are defining the market. And that's where I think there's that split. But fundamentally, if you don't reflect the consensus, you're not providing the product that you need, because it is supposed to be the level playing field for both active and passive. So, and I don't think we are pushing the market anywhere.
And I guess we're conscious of the time here, but one other thing that has gotten a lot of talk in this industry lately is this trend toward self-indexing. Even big issuers relying on smaller providers like a Solactive or something, which essentially just implements their ideas. Is this another sort of manifestation of the shift towards active? What do we make of this trend toward self-indexing?
Again, indexing, so I'm going to go with that, and as Solactive aren't here. But no, I think for me, an index is a conversation with market participants of understanding what the market beta is. If it's a conversation with self-indexing or if it's a single party, then that's a monologue, not a dialogue. And it's very important that you have that conversation so the market as a whole can understand how they need to assess both the passive manager and the active manager. So I think it's a trend, it's a disruptor, and adds value to make everyone assess what they're providing. But it's important that you have that broad options, and all the ESG and everything else that we talk about, product innovation. That's fundamentally, you need scale to be able to offer that, and you need the building blocks to be able to do that.
If I may add our perspective, so we're agnostic about the trend, or perceived trend around self-indexing. As an index provider, we are providing the market with tools, investment tools. But I think I do think it's worth highlighting that we shouldn't take the role of index provider too lightly. And I think agreeing with all the points you've raised about, governance is really key here. Having governance mechanisms, frameworks to be able to meet evolving regulation, that's a core competency of index providers like ourselves and others. Another thing is around having the index expertise to be able to rebalance indexes to reflect what's happening in the market, and as well as with investability accessibility, turnover criteria. So we have a comprehensive engagement frameworks to engage with domestic market authorities, with institutional investors to look at, for example, country classification status into developed, emerging, frontier markets. And then as well, I think the data side, I think we also often don't just kind of put in the back. If you look at, for example, our simple, broad, global market benchmarks, we're covering 80,000 companies, 100,000 securities, and over 230,000 issuers. Think about the technology, the operations, and the scale you need to be able to ensure that we have highly reliable, quality, and accurate data to input our indexes. And that's just on the market cap side. On the ESG side, we're evaluating over 14,000 companies. We are engaging with the markets. One criticism we often get is, as ESG becomes bigger, how are we engaging with the companies to make sure that they're disclosing information in a way that's reliable so that we can be able to integrate it into our indexes? So we're engaging with all the companies that we research to let them know how we're assessing them, what information we're collecting on them. And above that, we also have external committees that help inform us about our methodology and as well as our data. So what I'm trying to say here is that behind all of this, there's a lot of innovation, technology, operations that's needed to be able to scale up and add value to investors. So I think one should not take the role of index provider too lightly.
Isabelle, we'll give you the last word here. Is self-indexing veering dangerously close to the prop indexes, which regulators frown on?
I was going to answer through this route, actually, because there's a very we are operating UCITS ETF, and per se, we cannot have an index for one market participant, whatever it means, but it's really targeting proprietary indices, typically. The definition is quite broad and can be interpreted per se, because, as I said initially, the index needs to be transparent, the information needs to be available, the methodology needs to be disclosed and available for any market participant. But what we're seeing, despite everything I'm saying, is that there's a number of clients, notably asset managers, private banks, distributors, that wants to be exposed to indices which are public and on which they're not going to be the only one to invest. So self-indexing is not usually so much perceived as something that is public, broad, and for everybody. And on the other side, we have a number of clients and more institutions that are going toward the route of passive, switching from active to passive, and that are asking customized indices. So do you call self-indexing customized indices? I think self-indexing is a notion that comes from the US mainly, because as you said, we have the UCITS guidelines for ETF. There's also BMR, which prevent us as fund manager to launch our own indices. So it's a different concept, I would say, in Europe. I prefer to say broad indices, or broad not as a sense in terms of coverage, but being public indices and customized indices, which responds best to a specific need of a client, on which obviously we're going to work with external index providers, because under BMR we cannot, per se, as a manager, be also running indices.
Okay, a complex question, no doubt. And we'll leave it at that. So thanks very much for the fascinating chat. Please join me in thanking our panel.
Thank you.